Okay. Hi. Good evening, everyone. Thank you so much for logging into Marcellus's webinar on the impact of ongoing events on our PMS portfolios. So we understand there's going to be lots of questions. We can already see a very long list of questions there. Thank you so much for sending across those. Keep them coming. We will try to answer as many as possible during the webinar. But like we always do, whatever we can't answer during this webinar because of paucity of time predominantly, we will send you a separate reply by email over the next couple of days after the webinar. So let's begin. So this is Ashvin and myself. We will take you through how the portfolios, little champs and consistent compounders at Marcellus have performed, how their fundamentals have shaped up so far, and the most interesting and the hot topic, I think, on top of everybody's mind, which is the ongoing volatility and various factors leading to it. How do we see things developing during this? So I'll just scroll through the slides a bit. So this first slide that is coming up on your screen, it shows the performance of the two portfolios. The chart on the left is consistent compounders PMS. The chart on the right is the little champs PMS. It has been a lot more resilient than what some of the other stocks have done. So our consistent compounders portfolio has fallen by about 2.1% in the last 10 days, which is the month of March so far. Little champs has fallen by 3.5%, substantially lower than the respective benchmarks. More importantly, over the last 1 month, 3 months, 6 months, I mean, you can see 6 months, 1 year here in this chart. They've delivered a fairly healthy performance. So that's how the PMSs have delivered. Now let's quickly move on to how this performance has been supported by fundamentals. So if you've gone through the recent newsletter that we've published on both these products, the CCP performance, which you can see on the slide in front of you, the CCP performance has been, to begin with, very broad-based, right? So the chart on the left, the exhibit on the left, shows you the 13 stocks in our CCP portfolio. How their year-to-date till today, till 11th of March, how the YTD FY20 share price movement has been, and how over the last 3 years and 5 years, the share price movements have been. What is in particular worth noticing here is the spread, as in it's not driven by 1 or 2 stocks. It's actually pretty broad-based. For these stocks over the last 1 year, 3 year, 5 years time period. And more importantly, what you can see is on the chart on right, the fundamentals of these stocks have fully supported, actually more than supported, the increase in their share prices, right? So if you compare the chart on the right as earnings growth versus the chart on the left as valuations, as long as earnings growth is not lagging behind valuations substantially, there is no concern at all. In fact, in some cases, for instance, if you look at the financial year 2020, so the third column in the chart on the right, which is FY20 earnings, right? The earnings have gone up by around 31% based on the 9-month performance. That 31% earnings growth compares with 25% overall portfolio performance, right? So just to make the point again very clearly, as long as the 25% portfolio performance is backed by 30% sort of an earnings growth, we've actually become cheaper on PE multiples against the optical illusion, I would call it, that if the portfolio has delivered 25% in such a difficult time, then we might actually have become more expensive, right? So that's the performance in front of you. over the last 5 years as well, the gap between our portfolio's earnings growth and Nifty 50's earnings growth is the same as the gap between our portfolio's share price growth versus Nifty 50's share price growth, right? Which again suggests that our outperformance relative to the broader benchmark is supported by fundamentals fully, in terms of outperformance of the fundamentals versus the rest of the economy. And this is quite important to also digest, because over the last 5 years, India's economy has gone through a very turbulent time. It's been a very benign environment in terms of economic growth out there, and hence, with a 3% Nifty CAGR in earnings, the portfolio has instead delivered a 20% earnings CAGR. Right. So that's the broad conclusion. The summary has come up now. Now, why has this happened? And one of you has already asked us this question in this webinar already. I can see that why, if the economy doesn't grow, why do we expect our portfolio companies to keep growing their earnings? Now, this in particular has happened. The third bullet at the bottom, which you can see, is in particular because of accelerated market share gains. And ability to gain market share for great companies actually increases during difficult times, because when it's euphoria all around, it's very difficult to beat your competitors, right? So to put it very simply, for an HDFC bank to beat a Yes Bank 3 years ago would have been a lot more difficult than what it would be today, right? That's quite an obvious way to look at it, and hence it's actually the opportunity to consolidate market share in the acquiring segment.
It started now.
Okay. Sorry about that. There was some internet connectivity issue here at our end. So it's streaming, right? Yeah. So so we were on this slide number 3, where acceleration in market share gains, I was making a point, is the main reason why earnings growth is resilient despite a difficult economic environment. As long as that resilience of earnings growth sustains, the share price growth will also remain resilient, right? Now, the last bullet on this slide mentions about how the recent regulatory changes, especially things like corporate tax rate cut, GST, before that demonetization, etc. All these changes are creating a massive snowball effect, where the small and weak companies in every sector are becoming weaker and smaller, and the good and great companies in every sector are getting a very big opportunity to consolidate, right? So the firepower available to our portfolio companies after the corporate tax rate cut is going to be redeployed onto the balance sheet to grow their capital employed in various areas, which will incrementally help them to gain more and more market share, right? This could be by giving extra incentive to your employees in order to reduce the attrition rate. It could be accelerated capex. It could be cut down in product prices to suffocate competition where the competition doesn't have the benefit of lower corporate tax rates, etc. Right? Various sorts, and you can read more about it in our recent newsletter. Moving on, if you look at the Little Champs portfolio, very similar experience. Ashvin will take you through.
Yeah, so the Little Champs fundamental performance also closely resembles that of consistent compounders. So if you look at the last 5 years, the median earnings growth for the portfolio is close to 22%, when the small cap BSE small cap index has returned only 6% during that period. And as Rakshit, consistent compounder, the growth has largely come from gaining market share from unorganized players as well as weak players. And also one important thing I wanted to point out in this slide is that these companies have been able to maintain ROCs at a high level despite having a high reinvestment rate and while maintaining healthy earnings growth. So we had covered this aspect in our recent newsletter, why there are only a rare set of companies which are able to achieve this trinity of high ROC, high reinvestment rate, and high earnings growth. So one of the important success factors for Nitil Champs has been they have been very clever and smart about their capital allocation. So barring one company, most of the Nitil Champs portfolio, they have reinvested their excess cash flows mostly to grow the business organically rather than acquisitions. And couple of successful templates that they have followed is one is take your product pan India. So you are good at your product in one region, then you go into other region, replicate that success into the other region, and hence take it pan India, and hence gain market share from the local players who are there or the unorganized players who are there. So Nitil Champs have done it very beautifully. And the second successful template which they adopted is use your customer relationship or the distribution and leverage that to get into adjacency products. So products not completely different like chalk and cheese, but related to the current products, but basically sell it to the existing customers and distribution. So they have been very patient, very calibrated, very smart and clever about their capital allocation. And that is also why they have been able to maintain this ROC high for such long period of time and despite having high investment rate as well as the earnings growth.
Okay, great. So that's about the portfolio performance so far and the fundamental support so far. Now let's come to the hot topic, right? The interesting aspect of the near-term uncertainty. So this is what is happening. I don't have to go into details, but the concerns out there, I mean, the biggest concerns we've highlighted on the slides here, which are around the spread of coronavirus. Several countries have announced lockdown. How does that impact global supply chain? How does that impact global supply chains? Does it lead to a global economic slowdown, so on and so forth, right? So that's one layer of uncertainty. The other layer, I mean, got added, etc., is what happens to the crude oil price? What is the impact of that? And then we saw what we saw with Yes Bank. Yes Bank recently. Does that impact the financial space in particular? So those are the near-term negatives. The short-term positives also are that with the crude oil price fall, there is positive raw material cost benefit for several companies which are also in our portfolio. 3 names are mentioned there. And there's possibility of accelerated stimulus from various central banks globally, right? So that's happening in the global environment, which is obviously causing a lot of volatility in the stock market. Now, what's the impact? So let's first do quickly the impact on CCP companies, right? Fundamentals, impact on fundamentals of CCP companies, and then we'll come to a bit of non-fundamental factors as well. So the impact here on demand side for CCP companies is not much because our portfolio companies are selling products and services which are small ticket essential items consumed on a day-to-day basis, right? Predominantly by the middle class Indian household. This demand is unlikely to be materially affected by coronavirus, even if the whole country goes into a lockdown from a long-term perspective. So for instance, let's say the whole country goes into a lockdown. Hopefully, it will be a couple of months or 3 months, 4 months type of a phenomenon. Till the time that does not happen, the middle class household essentials consumption, right, of small ticket products and services will not be materially affected. Obviously, the top 5 cities, the top 10 cities affected by this might see some aspirational consumption within these categories get affected, some delay in aspirational consumption products, etc. But there will not be a material impact especially from a long-term perspective, right? Just to give you an example, if we're talking about Nestle's baby milk products, right? I don't think parents will stop feeding their infants formula milk because of the ongoing developments in the global and Indian landscape, right? So that's one example. Likewise for banking, likewise for let's say footwear, for innerwear, etc. There might be some delays, but not material. In terms of supply chain impact, right? So what if Chinese supply chain gets adversely affected? So exposure to raw material imports as a subject, exposure to raw material imports is there for only 6 out of 13 companies in a direct manner, as in imports forming more than say 5-7% of the overall cost of goods sold is applicable on around 6 out of the 13 portfolio companies, and those exposures are highlighted here. So Asian and Berger, the two paint companies in the portfolio, they consume titanium dioxide as a key raw material, right, which forms around 20% of their overall raw material consumed, right. Around 70%, 70% of titanium dioxide consumed in India is imported. 30% is procured locally, right? Now, even if we were to assume that Asian Paints also procures 70% or 80% of their titanium dioxide through imports, then China globally accounts for around 40% of global capacity for TiO2. So there is an option for substitutes here. And the exposure of overall RM raw material is around 20%, right? So that's one data point where the portfolio's fundamentals are exposed, and the remaining 4 companies here are also mentioned. So Pidilite's vinyl acetate monomer, which is around 15% of raw material consumed, is predominantly imported. However, Pidilite also has an in-house manufacturing capability for vinyl acetate monomer, right? So if the substitution were to be required, there is a possibility to substitute. Now, how much of capacity can be substituted, that's a different question. But to a certain extent, there are backup options available. Page Industries imports elastic, synthetic yarn, few other accessories, which at a global level are manufactured by China in large proportions. We don't know yet if Page directly imports from China, and if Page has the option very easily available to substitute them on this 15% of imports as a percentage of raw material consumed. Relaxo, again, around 35% of COGS are these two raw materials highlighted screens, and our sense is that the bulk of the global capacity is countries, especially Dow, DuPont, Basel, these types of large MNCs. China is not a primary producer of these commodities, and hence there is no exposure there. Divi's Lab procures some of its key RMs from China, but then over the last 12 months, they've set up several capacities to backward integrate and substitute the reliance on China. So that also has already come down. So there is, on and all, apart from these 6, there isn't any other company in the portfolio with direct exposure. Obviously, you can say there can be indirect exposures that we are not highlighting here on the slide. But this is, as long as it's a short-term supply chain effect, as in if it's a 2 to 3 or 4 month impact on global supply chains, then there's a small direct exposure, not a material one, right? So that's as far as fundamental exposure of consistent compounders is concerned. Now, on Little Champs, again, I will take you to these tables.
Yeah. So Little Champs portfolio companies does have exposure to global trade. So 4 out of the 12 companies, that is non-financials, they have more than 25% exports. But fortunately, they are primarily into Western geographies and more so into North America. So there is no exposure as such, large exposure to China or the other countries which have been infected the most. And out of these 4 companies, 2 companies have local operations. So there is no actually exports from India. Those products are produced in local subsidiaries, and those are sold in the local markets. So that was on the export side. On the supply chain side, one company has a direct imports from China. So that is the stock 5 in the slide on the right side exhibit. But barring that company, the other companies where the import is more than 20% of the cost of goods sold, those primarily petrochemical based raw materials, largely sourced from the Middle East, that the supply continues to be as it is before. So while the headline number there are export exposure, but export as well as import exposure, but nothing major to or from China or the other countries which have been infected the most. So yeah, there could be some indirect impact on the auto ancillary companies. While none of our the auto component portfolio company has direct imports from China, but the auto industry does have component sourcing from China. As a result, there could be an indirect impact on these auto ancillary portfolio companies. But fortunately, most of the components that are sourced from the auto by the auto companies from China, there are second and third source. So I think over say like 6 to 12 months, I think as these companies can source more and more from these alternative geographies, and hence they can make up for the component short from China. We see sort of impact of this event on our portfolio companies for retail champs.
Okay. Okay, I think we just got some feedback that slides were not visible for some part. Okay, now just let me know if you still can't see it. With a lag, it comes. So, so this is the next slide. Now, so thanks, Ashwin. So that was the fundamental impact. Now let's look at the combination of fundamental and psychological impact that market corrections have on share prices of our portfolio companies, right? So let me first explain what this chart is all about. This chart was, by the way, published, I think 8-9 months back in one of our newsletters of consistent compounders. So this chart shows you on the vertical axis, Asian Paints' share price movement for each financial year over the last 40 years. And on the horizontal axis, Sensex's movement as an index in the same year over the last 20 years. So there are 20 dots on this chart. For each dot, the vertical axis value is the Asian Paints share price movement. Horizontal axis value is the Sensex index movement. Yeah. Dots on the left show you years where Sensex delivered a negative return, right? Dots on the bottom of the horizontal line show you years when Asian Paints delivered a negative return in a financial year. Now, few very interesting conclusions here. So Sensex delivered a negative return in 6 out of the last 20 years. Yeah. By the way, you can do the same thing for the last 25 years period or 30 years period. The last 25-year analysis we've shown in our book Coffee Can Investing. Last 20 years have had 6 years of negative return for Sensex. In Paint, over the same 20-year period, has had only 2 years of negative return, right? What that has meant, and you can see those which are in the bottom left quadrant, right? What that has meant is there are several dots which are to the left of the vertical axis, which means Sensex was in the negative, but above the horizontal axis, which means Asian Paints was still positive, right? So there are 4 out of the last 6 years of stock market crash when Asian Paints delivered a positive return, right? I repeat, so 2/3 of the instances of stock market crash led to Asian Paints still delivering a positive return, right? Now, this is when Asian Paints has always traded at a substantial premium to the broader market. 25 years ago, it was at 45 times PE multiple. Today also, it is at a similar PE multiple. Only for a short period of 5-6 years over the last 20 years, it was at a 20-25 times type of a PE multiple. Otherwise, it has always traded at a rich PE, especially relative to the market, very high PE for the entire 20-year period, right? Now, despite that, this firm has actually not fallen in 2/3 of stock market crashes. More importantly, the last bullet that you see at the bottom, the opportunity loss of missing out from investing in Asian Paints is that 13 out of last 20 years have had more than 20% annual share price return from Asian Paints. Interestingly, 2 out of those 13 years, you can see those dots above the dotted red line, but to the left of the vertical line, right? Top left quadrant above the dotted red line. There are 2 dots which actually were years of Sensex negative, Asian Paints more than 20%, right? So if you sit out waiting for a good entry point during a stock market crash, to begin with, it's a stock market crash and the depth of it and how long it will last. But even if you get that right, sitting out on cash is not advisable in a stock like Asian Paints, because there's a very high probability that not only will Asian Paints deliver a positive return during such a period, it will actually deliver a very healthy positive return of more than maybe 20% during such a period, right? Now, this phenomenon is not unique only to Asian Paints. So in the next slide, what you can see, this exhibit, right? What I explained for Asian Paints on the previous slide has actually applied to every consistent compounder, which has been listed for the entire 20-year history from our portfolio, right? All these 4 companies that you see have demonstrated, if you look at the third last row, a positive return when Sensex was negative. So remember, there were 6 instances of Sensex negative, and these firms were delivering a positive return most out of the majority of those 6 instances, right? And of the last 20-year period, they've delivered more than 20% absolute return, which has also been in years when Sensex has delivered a negative return, right? So this is something which is actually backed by sound logic. So the logic is very simple. Let's say if Asian Paints' earnings go up by 25% in a year, right? And at the same time, the P multiple for the broader index falls by, let's say, 20%, right? Even if you assume Asian Paints' PE collapses along with the broader market's PE, the correction in the PE multiple will be more than offset by earnings growth for Asian Paints. The same will not be true for a Sensex or a Nifty 50, where the earnings growth is not strong, right? Hence, perhaps the share price fall is a lot more prolonged, right, for the broader index. So that's a simple logic. It's mathematics. We've explained this in our previous newsletters. And if you look at the last 6 weeks or 4 weeks of stock market correction, you can see the same resilience, right? We have our portfolio has fallen over the last 6 months. But interestingly, if you compare it with 31st December 2019, right, the portfolio is still up, right? So we've fallen from our peak NAV by, I think, 7 or 8%, if I'm correct, right? But still, we are 3 or 4% higher than the 31st December NAV, right? So for the YTD of January this year, so calendar year YTD, we're still positive. And if firms consolidate market share in a difficult external environment over the next 12 months in an accelerated way, right, you will see this pattern which we've shown in this slide and the previous slide continue, right? And again, I'm stressing on this point because we've seen several of you are asking a very I would say intuitive question, that isn't it the case that when the stock market falls, companies with high PE multiples fall more than companies with low PE multiples, right? It would be true, right? This logic would be true, provided companies with high PE multiples are not supported by fundamentals when it comes to their valuation. So if the fundamental support to a high PE is not there, then certainly the mean reversion applies and the share price will fall a lot more than the share price of a low PE multiple company, where hopefully fundamental support is a little better, right? In our portfolio company's case, actually, and I'm again referring to the slides right at the beginning of this presentation that we showed you, the fundamentals have actually done better than the share price movement over the last 1 year, and they have moved exactly in line with the share price movement over the last 3 years or 5 years. So there is actually no gap opened up between the fundamentals and share prices of our portfolio companies. Unlike the broader market has actually seen a little bit of gap opening up over the last 5 years, right? So whilst the correction in the broader market's PE multiple might be justified to begin with because of lack of fundamental support, on top of it, whilst that correction might be deeper and longer lasting because it doesn't have fundamental support possibly over the next 6 to 12 months, if our portfolio companies deliver much more robust and much better and healthy earnings growth over the next 1, 2, 3 years, then it is absolutely futile trying to wait for their share price correction in a meaningful manner and get a very low entry point, because that might not come for many of the portfolio companies, right? So that's a very, very important message to drive home and think deeply about. And as I said, we've written newsletters on all this, so please go through that, and happy to answer more questions on the subject. Now coming to the overall conclusion. So this slide 10, is highlighting a question which I'm sure many of you have on top of your mind, because this is actually the most frequently asked question in a time like this, and there is some logic to the question, I would agree, right? Because theoretically speaking, it might appear that why not sell everything if the market is going to crash by another 10-20% and our portfolio might crash by another 5-10-15% from here. Why not sell everything, wait out on cash in this market fall, and get back in when the dust settles? Now, the challenges in doing this are, to begin with, nobody knows how long and how deep will be the stock market stress, right? Just to point out, actually, it's very interesting here. I'm sure many of you have gone through the phase of demonetization, right? After 8th of November 2016, we saw the next 3 months, which were as volatile, I would say even more volatile than what we are seeing now, where every day our view of how the country will evolve after demonetization, the view was changing, right? And as a result, there were days when the market would go up, there were days when the market would go down. Overall, there were views, for instance, I still remember, there were very logical arguments at that time. It appeared logical around things like, why would anyone paint their house in as high a frequency as they previously? Why would anyone do refurbish their house, and hence the use of Pidilite's products with the frequency that they previously, when there will be no cash lying in the wardrobe? Because that cash lying in the wardrobe for most households was the reason why painting was done a lot more frequently than it would be if there was no cash in the wardrobe, right? And similarly, there were various other arguments built around various other companies. The stock prices fell. It was totally logical to believe that this correction is here to stay. It will get deeper and deeper much sooner, right? And that's, I'm talking about the phenomenon highlighted in the third bullet on this slide. The recovery happened before anyone could see fundamentals recover at a ground level, right? ATMs had not yet started dispatching rupee notes, currency notes, right? Businesses, I mean, I remember some of my relatives sitting in Ludhiana used to tell me that the entire textile industry is shut in Punjab. The entire labor workforce is out of their jobs. Nobody is going to do aspirational consumption, so on and so forth. A good 2 or 3 months before things started recovering at a ground level, stock market had already recovered, and it was already sitting at levels much higher than pre-stock market crash levels, right? And the same happened during 2008-9 crisis. The same happened during the IL&FS crisis, the liquidity crisis, 2 years, 1.5 years ago. The same happens every time. No one can directly correlate ground level fundamentals, situations, evolution with stock markets short-term share price movements, right? As a result, theoretically, it might appear possible to time entry exits. Practically speaking, it is just not worth it, right? So that's a broad way to answer this frequently asked question, and I'm sure many of you will have different variants of this. So another variant of the same question is, if you do a top up, right? If you do a top up into our account, will we be deploying that top up right away, or will we be sitting on cash for some time and then deploy in a staggered way or all at once when the market has corrected further, right? We really don't know whether tomorrow the market will be lower than where it is today, whether 1 week out or 1 month out, it will be lower than where it is today. All we know is that if we start timing top-ups like that, right, we'll be spending unnecessary bandwidth in areas where it's literally a matter of luck. And over a 3-year, 5-year CAGR, it will not contribute much. Even if we were lucky, right? Even if we were lucky, it will not contribute much to your 3-year or 5-year CAGR. If we get a 5 lower entry point on the same top up, we might actually also get a 5% higher entry point if we do that exercise. So in that way, our current stance is, you give us a top up, we will deploy it just like we do in a normal market within the next day or two. As long as there is no price impact because of our trade, we will go ahead and deploy it, right? So that's how I would end this. But happy to take any questions. I'm sure there are too many questions, so let's go through them, as many as we can address.
To Rakshit and Ashwin, the first question is really on do you have any views on how bad can things get? So both from a point of view of, there are 2-3 factors which have all come together at around the same time, and there are questions on, can there be a global recession? Can India get into a lockdown of cities as some of the other countries have done? And at the end of it, whether this leads us to the path of a recession.
Sure. So it's a valid question. Unfortunately, many of you might have already guessed what the answer will be from us on this. Will India get into a lockdown situation completely? I don't know. From a personal health-oriented aspect, I would say I hope so. It doesn't. But from an investment perspective, even if it does, I don't think there is too much of worry, because to begin with, when it comes to global recession and hence impact on India, India is a lot less correlated as an economy. India is a lot less correlated with the global economy compared to various other countries, right? So just to again highlight the way we explained the impact of global supply chain disruption on some of our portfolio companies, there is less of a correlation compared to what you would have seen had you invested in a paint company in America, or had you invested in an adhesives company in Germany, or had you invested in, let's say, an FMCG company sitting in China, etc. Right? The reliance on global supply chains is a lot lower in India than elsewhere, but it is not zero. Obviously, there is some reliance. So to that extent, the global economic recession or that sort of a question is less relevant for India than it would appear, right? In particular, as long as this problem and its impact on the economy lasts for the next 2, 3, 4 months and not beyond that, right? Which at the moment it appears to be so beyond the next, say, 2 to 4 months. If this is history, then during that 2 to 4 month period, as I give you an example of demonetization or 2008 type of a crash, it would be very difficult to time the bottom, right? If it's a 3 month problem, the bottom might be 1 month out or next week or 2 months out, God knows, right? So very difficult to time it. What we can safely say is, as long as our portfolio company, so as long as an HDFC Bank, Bajaj Finance, Kotak Mahindra, that trio, they can consolidate the entire BFSI space, because the aggressive lending which used to happen 3 years ago to a disciplined borrower doesn't happen anymore. And the liabilities side of the balance sheet is flush with excess capital only for a limited number of lenders in the country, right? As long as that phenomenon persists from a next 2 to 3 year perspective, we should not be too worried about earnings growth of some of the financial stocks in our portfolio. Similarly, as long as an Asian Paints or Pidilite, they can use the excess cash available to them from FY20's reduced corporate tax rate to actually squeeze out competition even further, their ability to consolidate market share over the next 2, 3 years will not be curtailed because of the next 2, 3 months of disruption in global supply chains or lockdown in India, etc. Right? It might or might not be a 1 quarter phenomenon even, because when you look at things like lower crude oil prices, it might actually be positive in the short term. Eventually, it doesn't matter where crude oil price is, because Asian Paints will not leave any breathing space available in the industry for their competitors, right? And hence, if there is a benefit from the crude oil price in the short term, they will certainly pass it on and make it difficult for competitors to survive. But in the short term, there might actually be some positive offsetting factors compared to the obvious headwinds that are visible. So, broad answer to the same question: we don't know how long and how deep will the correction be, right? All we know is that beyond, in the worst case scenario, beyond a few months of fundamental impact, that too limited fundamental impact, our portfolio companies are not materially exposed. And hence, when you go back to those charts of resilience of share prices during a stock market stress, I think those charts will be repeated, right? So provided you believe that this chart on slide 8 will again see a dot on the either top left or top right quadrant over the next 2, 3 years, right? We are not worried, right? So that's how I would conclude.
And now, related question is that beyond China, so in the presentation you discussed about supply chain disruptions. Beyond China, is there any cause to worry about, say, South Korea, Italy, even the US? Probably things getting worse. Is that a concern that you have right now?
So again, so as we highlighted, when it comes to consistent compounders, hardly 6 stocks out of 13 have 10-15% of raw material procurement exposure, right? Which also has options for substitution, right? So whether it be China or South Korea or the US, as long as the exposure is low and can be substituted, there's no concern. Similarly, what Ashvin highlighted in his slide on LCP, there isn't much of a fundamental impact beyond a certain extent.
Yeah, I think barring a couple of companies have high exposure to US and those exported directly from India, we don't see, beyond these 2 stocks, the extent should be significant. Impact should be significant.
Now, guys, for CCP stocks, if there is, let's say, a protracted slowdown in India, right, both because of the banking system crisis or stress, as well as virus-related issues, crude oil related, which results in lower incomes in exporting countries. Uh, if that impacts the growth of CCP companies, right? How does that change your view on your forecast on what earnings growth and ROCs that they earn for the next couple of years? And if there is a significant variation in that, how do you look at them in the portfolio?
Sure. So, it's a good and valid question, but again, a difficult one. But let's give a maths to answer that, right? So the maths is simple. In a normal economic environment, right, which hasn't been the case for the last 5 years, in a normal economic environment, our portfolio companies have an ability to deliver around 25% plus minus a few percentage points of earnings growth compounding. Right? That's what they were doing before 2014-15. That's what they might do. Let's say the financial companies in our portfolio in the aftermath of the liquidity crisis, the surviving great companies always tend to accelerate their lending. That too with expansion in NIMs and compression in NPAs. Right. So earnings growth of around mid-20s in a normal economic environment is a likelihood. When the economic environment becomes tougher, so last 5 years has been a 5 to 7% moderation in earnings growth for Sensex Nifty, right? That has led to a 4 to 5% moderation in the CAGR of our portfolio companies' earnings, right? And hence, over the last 5 years in a difficult environment, when the broader benchmarks have delivered 2, 3, 4% earnings CAGR, our portfolio has delivered around 20%. Now, let's assume it goes down even further. So let's assume that Nifty 50, Sensex, they all deliver minus 5% type of an earnings CAGR over the next 3 years, right? If that were to be the case, then possibly our portfolio companies will deliver maybe 15% earnings growth, right? Now, if that were to be the case as a 15% earnings growth, even if their PE multiples, right, they reduce by say 20, 30% from current levels over the next 3 years, right, it would still make a lot of sense to stay invested, because this portfolio with, let's say, 15% there or thereabouts as the worst case earnings growth situation, if it then delivers a share price growth of 15 minus 5, 6, 7, right, and hence let's say high single digit or closer to 10%, as long as that's the worst case scenario, which actually has been the case historically as the worst case scenario for this sort of a portfolio, I think it would still make a lot of sense to stay invested here than anywhere else. So quality, provided you believe in the portfolio companies to be really quality, because quality is also a buzzword. Many people perceive some stocks to be quality, which they aren't. But provided you stick to genuine quality, and that then delivers, let's say, a mid-teens earnings growth in a worst economic environment over a 3-year period, right? Still, 8 to 10% share price growth is the likely outcome. And the best way to understand this is if you look at 1994 to 2004. Right, that 10-year period, where not only did Sensex Nifty deliver 0, 1, 2% as their index level returns, right? It was also when the P multiples had halved for every good quality company as well as the broader index, right? So that 10-year period possibly saw the worst case scenario in this sort of a compounding, where Sensex Nifty, I think they went practically nowhere for a decade, right? In that sort of a situation, a firm like HDFC Bank, Asian Paints, they delivered a 20% odd earnings growth, -7, -8 contribution from P multiple compression on an annualized basis, and a 10-year CAGR of the share price of 12, 13, 14%. There might have been a 6-month period when the share price CAGR was in -5% or +5% type of a territory. But otherwise, the earnings growth was pretty consistent and sort of healthy, not 25, but maybe 15, 20. The share price growth was likewise a 10 to 15% type of a band. So as long as that's the worst case scenario for the next 3 years, I think we're still quite all right, because there won't be a better way to invest and compound your wealth with capital protection.
So there's one related question which you largely answered, but if you can just reinforce the point. So the question is, even if these stocks do better than the index or the market, right? The portfolio does better than the index or the market. There can there still be an absolute correction, and do you lose money? You just answered that question partly. If you can reinforce that.
Yeah. So worst historical correction drawdown for the market and for these portfolio companies was the FY09, right? The global financial crisis, where the markets fell by around 68%. I think Nifty 50 and 63% Sensex, something like that, with a 60 to 70% correction in the broader markets. This portfolio, these types of companies broadly corrected by 25 to 35%. Right? That was the FY09 share price outcome of this. Some companies were minus 40, some were minus 10, right? Overall, minus 25, minus 30 was the drawdown of these sorts of portfolio companies, right? The more interesting point is, as I said, theoretically speaking, it might make sense to exit before that fall and enter at the bottom. But the recovery was so soon and so sharp for these portfolio companies that before you could realize, FY10, which was the next financial year, these companies not only participated in the broader stock market recovery, they actually, some of them almost doubled in their share prices, right? Some of them went up by 50, 60, 70%. Not only did they recover the entire drawdown, they were at substantially higher share prices compared to the pre-crash levels. Sensex Nifty took, I think if I'm correct, Sensex Nifty took a good 2.5, 3 years to come back to their pre-crash levels, right? Some of the stocks, they haven't yet, after 10 years, they haven't yet come back to their pre-crash levels. Now, when you put a quality gradient across all these outcomes, right? Stocks which are still today in 2020 below their 2008 peak are the poor quality fundamental stocks. And the stocks which recovered in less than 12 months after their bottom was hit, and the recovery was more than 100% share price movement from the bottom, they were the highest quality stocks, some of them which are still in our portfolio. Sensex as an index, Nifty as an index is somewhere in the middle in terms of quality, neither too great nor too bad, because it's an aggregation of all sorts of companies. And hence, the outcome after the crash of Sensex in terms of time it took to recover, the slope of recovery was also somewhere between a bad quality and a good quality stock. So that's the worst case scenario. I don't see any reason to believe with certainty that sort of a worst case is about to happen. But even if it were to happen, right, I doubt if you would be disappointed over a 2-year, 3-year, even over a 1-year period of holding in this sort of a portfolio. There will be a 3-month negative, 6-month negative performance. So for instance, this month has been -2. Last month was -1.5. So in 1.5 months, we've had -3.5%. So absolute, it is negative. But I don't think there is any way you could have predicted this way back in January. I don't think even today you can predict where it will be 1 month from now.
Then Rakshit, we have a whole host of questions on a point which you stressed upon in the presentation already, is on market timing. So which you clearly said is not something which you can catch the bottom. But the questions are, even after this, there are many questions on, should you wait before people top up or make fresh investments? And once they make the fresh investment or the top up, will you wait to deploy the money?
Sure. So, in some ways, I've given some sorts of answers to this question, but let me give another variant. So in our first March 2019 newsletter, so this is first March 2019, Marcellus's Consistent Compounders newsletter, we had given a simple analysis. So let's say you are Mr. Gifted and I am Mr. Mortal, right? Let's say we are two individuals, we are investing our hard-earned money, whatever salary we get, let's say 100 rupees is our annual, and we decide to invest that 100 rupees into the stock market, right? Let's say both of us choose Asian Paints or HDFC Bank or some other great quality fundamental franchise, right? Now, what if you are Mr. Gifted and you have the ability to time the 52-week low for every calendar year over the last 40 years, right? And I am Mr. Mortal and I have zero ability to time market volatility, and hence what I do is I just blindly invest on the 1st of January, which is the day after I receive my, let's say, calendar year bonus. I invest my 100 rupees on the 1st of January into the same stock regardless of the share price, right? If I were to do this exercise consistently, and if you were to do the same exercise at 52-week low every year consistently on a stock like Asian Paints, a 5-year, 7-year, 10-year CAGR, the difference on average will be you will make 29% CAGR, I will make 27%. That's it, right? My wealth at yours minus 2 percentage points when the absolute return will still be 27% for me. Why? Because the earnings growth for Asian Paints during that period on average would be 25, 27, 30%. Timing it here or there will add a couple of percent up or down. Broadly, you as well as I will get the earnings growth plus minus few percentage points, right? Now, let's assume instead of Asian Paints, we invest in, let me not take stock names here. Let's say we invest in Nifty 50, right? And we pick up the rock bottom as Mr. Gifted, you pick it up, and I invest on 1st of January in Nifty 50 or Sensex, right? To begin with, the volatility in Sensex and Nifty 50 on a 1-year basis will be much, much higher than Asian Paints. More important, absolute average annual return will be much, much lower. So to quantify, the outcome will be Mr. Gifted will probably make 13, 14% CAGR. Mr. Mortal will probably make 10, 11% CAGR. The gap might be a little more than 2 percentage points, but 10% versus 13% is a substantial difference in wealth creation, because I'm sure our lifestyle cost might be around 10%. So you are compounding better than your lifestyle cost. I am not, right? When it comes to 29 versus 27, 25 versus 23, 20 versus 18 even, I would say, it does not matter much, because the cost of, to begin with, this 2% gap that I theoretically showed you exists if you are genuinely Mr. Gifted every year over a 5, 7, 10-year time period, right? Which is unlikely to be the case. Even if you do that, right, the cost of staying in front of your TV screens, watching the market fall, rise, timing 52-week high, low, right? The transaction cost involved in, I would say, the psychological bandwidth, so on and so forth, right? It just doesn't make sense for that extra 2 percentage point, which actually is the best case scenario of being Mr. Gifted, just doesn't make sense, right? Obviously, if you do the same exercise on a 2-month return basis, if you say, I want to pick up the lowest 2-month point and you pick up the highest 2-month point, there will be a massive gap. I haven't quantified it, but there will obviously be a massive gap. But I don't think any of our clients, especially who are taking out time to attend this webinar, want to make return in a 2-month period, right? As long as you are trying to make return over a 3-year, 5-year, 7-year period, doesn't matter whether you catch the rock bottom during a calendar year or whether you don't. What matters is, did you get the earnings growth, which was healthy and consistent. If you did, you're home with a healthy wealth compounding. If you didn't, then nobody can help you, even if you can be the luckiest man on stock market timing.
Ashwin, there's a question for you. In this, the way the scenario is right now, LCP stock most likely will get impacted more than the CCP stock. So in that scenario, whether do you have any views on buying any fresh inflows today or over a period of time? Do you have any cash calls? So you want to retain cash and have an optionality of using that at buying stock at better prices? And third is, why restrict to 15 stocks and not have 30 stocks so that there's more diversity and there's lesser perceived risk in scenarios like this? So 3 parts to this question, if you can just.
Yeah. So as highlighted in the slide on the Nifty Champs, so there is some pockets of the Nifty Champs portfolio where there will be impact from the disruption in the global trade. So there are around 3 to 4 stocks which have exports more than say 25%. Similarly, there will be stocks where they have import exposure of more than say 25%, not necessarily from China, but from say other countries. But wherever these pockets or influence would be there on the fundamentals, these stocks have corrected by around 15 to 20% already actually. So unless we are making a call that there will be prolonged, say like years and years of impact of the disruption in the global trade, as Rakshit said that we don't know exactly. So whether this will last for 3 months or 6 months, but if tomorrow, there is a lot of uncertainty which goes away in the say next 1 month or so. Most of these stocks are deeply, they sort of have significantly risk reward in their favor already. So as I said, wherever there are obvious impacts, those stocks have already corrected by 15 to 25% on our portfolio. So so sort of honestly speaking, no straight answer over there actually. So as long as we don't know the sort of how long this will continue. And on the second question regarding why not 30 stocks and why only 15 stocks. So as in our consistent counter portfolio, also we think that there are only a handful of stocks which meet the criteria of. Just to reiterate, what we look in the stock are 3 things. One is that the corporate governance should be impeccable. So secondly, the capital allocation should be great. And thirdly, we are looking for dominant franchises. And as I showed in the first slide on Nifty Champs, we want companies which are able to maintain high ROC over a long period of time, while combining it with higher investment rates and high earnings growth. So as I said, there are only a rare set of companies which have been able to maintain this trinity. So, and that's also reflected in the number of our stocks. We think that there is only a handful of stocks which are able to meet this criteria, and hence sort of will place of this concept portfolio.
Talking of criteria, there are some questions. Let's say that slowdown in economy and growth is impacted for companies, and they don't meet our filter criteria. What do you do?
So, I mean, there are 2 ways that the growth doesn't meet our criteria. One way is a 6 or 12-month issue, right? So best examples, look at FY17. FY17, Relaxo had 0 revenue growth and 0 earnings growth, right? Look at Page, last 4 quarters. Look at Nestle, 2015 Maggie fiasco. Look at 2009 capital misallocation, FY09 capital misallocation impact on Pidilite's return on capital, right? The impact is short-term oriented on growth. I don't think we are too worried, because once in 10 years, once in 20 years, many of our portfolio companies, they miss the fundamental growth criteria. That's the reason why we have a portfolio of 10 to 15 companies rather than having a 2, 3, 4 stock portfolio. If, for instance, in the worst case scenario, let's say if the worst comes to worst, and I'm talking about something totally hypothetical, right? That India goes the Zimbabwe way or the Venezuela way, where the entire middle class is gone, and there's either people below poverty line or people who are consuming stuff produced outside of this country, or what produced sold by companies which are not in the listed universe, so on and so forth. If that sort of a worst case happens, then obviously, I mean, this philosophy won't make money. That's one of the big risks. But so far, we don't see that happening. I mean, the largest part of Indian economy is consumption. Within consumption, the largest part is middle class household consumption of day-to-day essentials, right? This part is the most resilient part, right? Provided our portfolio is fully oriented towards this part, the day-to-day middle class household consumption of small ticket items will not go down by 50% year on year for 3 or 5 years in a row, right? Because if it were, only then the scenario that someone like an Asian Paints, despite growing market share, might not be able to deliver a positive earnings growth over a 3-year period, right? So in that sort of a situation where our portfolio is actually oriented towards the most resilient part of Indian economy, right? The worst case scenario in a practical manner, that Venezuela, Zimbabwe, what I said was obviously the sort of theoretical way to put it. In a practical manner, the worst case scenario is still not too bad in terms of earnings growth rates, right? So that's
okay, now we'll move on to some of the stock specific questions. One is on, in fact, probably the most number of questions are on ITC. If you have any views on that being in the portfolio, both from a stock price return point of view and from the reason why it is there from an earnings point of view. So if you can give your views on both these.
Sure. So that's a very nice way to ask this question. Give it in a stock price point of view, earnings point of view. So let's do the easy one first, which is earnings point of view, right? So FY15 to FY20. By the way, ITC stock number. Can I go back to slides on this? So let me take you to the slide straight away. So let's talk data only, so that I can't be fooling around while trying to answer this question. Okay, yeah. So slide 3, hopefully, which is now up on your screens. Stock number 6 is ITC, right? Stock 6, I can see earnings growth over the financial year 20 is in the high 20s. The last 3 years has been 15%, if I can read it correctly. Is it? And the last, it's a little slow on my screen. So it's about 15% and around 10% over the last 5 years, right? So a 10 to 15% over the last 3 to 5 years, and okay, and 25 to 30% in financial year 20 is the earnings growth for ITC, right? So my colleagues are telling me that the video was possibly buffering. So let me just repeat. Stock number 6 in this slide number 3 is ITC. Chart on the right shows you 25 to 30% earnings growth for the last 12 months and 10 to 15% earnings growth for the last 3 to 5 years. Is that good enough by our expectations? According to expectations, yes, it is. Right now, despite that, what you can also see is the financial year 20 minus 30% on a somewhere around 28% earnings growth, right? So think about what the P multiple would have done to deliver a -30 after having delivered 28% earnings growth, right? Last 5 years -1, last 3 years -10. Obviously, add on top of this. Okay, the slide is still not coming. Okay, let's see. Sorry, I was told that the slide wasn't displaying properly, so I've clicked a couple of slides back and forth. Let's see if this works. So, assuming the slide is now on your screen, stock number 6, ITC, 25-30% earnings growth last 1 year. Despite that, the stock is down 30%. So the P multiple has halved, right? And last 3 years, last 5 years, the earnings growth has been still pretty healthy, right? So that's the fundamental backdrop. We are quite all right with that. Going forward as well, we expect a similar earnings growth, where 12% odd should be cigarette earnings growth. The dominance is very deeply motivated. Don't see market share losses resulting in either earnings growth moderation or ROC compression of the cigarettes portfolio. If at all the non-cigarettes portfolio adds a layer of icing on top, then maybe 13-14% is the ITC earnings growth. Now, mind you, the normal dividend yield on ITC is around 4%, I think, right? On top of it, this firm is sitting on more than 30,000 crores of undeployed cash and cash equivalents, right? We don't see any avenues for deployment of that capital, especially because more recently the management has very clearly suggested that even in hotels, which used to be 4% of incremental capital deployed, hotels was only 4% of incremental capital deployed over the last decade. 4% of operating cash flow, 4% of operating cash flow was going to hotels as a capex. Even that number will substantially moderate going forward because they are going to do more on properties leased out rather than, or properties owned by non-ITC entities, as in they'll just be the managers of those properties. So we don't see this 30,000 crores, which is roughly 17-18% of current market cap, if my calculation is right. That 30,000 crore plus of surplus capital, we don't see it getting deployed somewhere. Now, whether it gets returned in this form or that form, what timing of capital return happens, we don't know. But without considering this capital return, a 12-14% earnings, 4% dividend yield already takes total shareholder return into the high teens territory. If there is something else on top from surplus capital coming back, then maybe even a higher number. If not, then at least 16-17% is the bare minimum total shareholder return that we're looking at, right? So that's the reason why we keep holding on to it. It is the smallest allocation in our portfolio because we don't like to hold companies which have low earnings growth. Here, the earnings growth comes with a fat layer of dividends on top. So the reason for having a lower allocation is reduced earnings growth expectations compared to an HDFC Bank or an Asian Paints or a Pidilite, etc. Right? But still, a high teens total shareholder return is pretty healthy, backed by robust moats.
The next stock-specific question, Rakshit, is on HDFC Bank. The stock hasn't really done that well in the last few months, almost a year. And with the impending management change, would you see any risks to continuing to hold it in the portfolio?
So again, let's answer the same question first in a fundamental way, then on a stock price. So the fundamental way, last 1 year, where I don't know what the exact stock price return has, let's assume it's flat, right? Last 1 year, earnings of HDFC Bank, and let me also tell you which stock is HDFC Bank in this. HDFC Bank is stock number 5, right? So stock number 5, which is HDFC Bank, let's see what it's. Yeah, so it's delivered 5% over the last 1 year, right? After having delivered a mid-20s earnings growth over the last 1 year and around 20% over the last 3 and 5 years, right? So it's right up there in terms of our earnings growth expectations being delivered upon, right? So we're not worried on fundamentals as they have been reported over the last 1, 3, 5 years period. Now, what happens to the successor of Aditya Puri? Who is he? What will he do? It's totally speculative to make any stock call on that basis at this stage. Right? We don't know who that person will be. Once we get to know about him, then certainly we will keep our ears close to the ground to see how things are shaping up, mostly at the top end level in terms of strategic planning, in terms of long-term capital allocation decisions, etc. Right? Uh, because it's an institutionalized business with very robust systems and processes, we do not expect an immediate positive or negative impact of the successor on HDFC Bank's fundamentals. An immediate meaning within the next 3 months of the successor being announced and taking control. We do not see HDFC Bank's 20% earnings CAGR, which it has been the case, those fundamentals materially changing either for better or worse over a 3 to 6 month period. So we will keep our ears close to the ground. We will keep watching how the situation evolves. In fact, if you look at how the lending environment is likely to evolve over the next 3 years, given the position in which HDFC Bank currently sits, it is certainly going to lead the consolidation of the entire lending space in this country, right? It is only 6-7% of total credit in India, with perhaps the strongest and the most resilient liability side franchise, one of the most disciplined asset side, and a totally process-oriented competitive advantage, right? I don't think you can change this construct as a new successor, as a successor to Aditya Puri within a 3 month, 6 month period, right? If the longer term, and I have to acknowledge, in India, we have not seen a single good quality bank go through succession planning without turbulence, right? Unfortunately, that's been the experience of the limited history of private banking in India over the last 25 years. We have not seen the top man's transition lead to zero turbulence in the subsequent 5 years. I don't know whether HDFC Bank will be the first such bank or not. Asian Paints, for instance, in 1997, Asian Paints saw the main promoter family exit after the death of Mr. Champaklal Choksi, and that still didn't rock the boat because it was such a beautifully institutionalized construct. Since 1997, we've seen 3 generations of promoter change hands at Asian Paints. We've seen several professionals change hands as CEOs. The next change is actually underway. 1st of April, Mr. Amit Singhal takes over from KBS Anand. There is a change in the CEO. Asian Paints has proven it time and again that it is a totally institutionalized company. Does not matter who's running it from the top, the beauty sustains, right? Obviously, the main man has to keep nurturing this beauty, but they've been able to successfully nurture it through several succession plannings, right? Whether HDFC Bank will be the first such bank to go through it, I don't know. We'll keep a watch out. But I think it's totally foolish at this point to either sell HDFC Bank waiting for absolute clarity to emerge on the successor strategy, or to say that I will be complacent enough not to take any call and I'll keep holding on to HDFC Bank for the next 20 regardless of the successor is, right? So we are not going to take either of the 2 extremes. We'll keep, but we're quite all right with the fundamentals as they're likely to evolve in the foreseeable future.
Okay, now the next question is quite an interesting one, and Rakshit, you and Ashvin both probably need to answer this. In this, the churn that is happening in the economy in general, right, which is accentuated by these recent factors, our view also has been that there will be consolidation in almost all business segments, and the larger guys will get larger and they'll take share away from the smaller names. Now, does that mean that LCP companies suffer and the CCP will, you can buy that will or will not happen.
So let me give one point and then I'll let Ashwin answer. I don't think LCB companies are number 3, number 4 market share controllers in their respective categories. And I don't think CCP companies are actually competitors to LCB companies not in a direct way, but relative positioning vis-a-vis competition, right? So that's how I would say you should look at it. But Ashwin can maybe give more.
Yeah. So as I said earlier, that Little Champs portfolio also we are looking for dominant franchises. The only difference between CCP and Little Champs would be CCP would be a dominant player in a large market, whereas Little Champ company would be a dominant franchise in a niche market. So there is no direct competition. So Little Champs portfolio we are not invested into number 5th, number 6th, or number 7th player in the industry, because we are obsessed with the player with dominant franchise with good pricing power. So by default, we are choosing the market leaders in the niche market. And as with consistent compounders, one story which has helped Little Champs portfolio over the last 5 years. So if you remember, Little Champs portfolio has also delivered 22% earnings growth over the last 5 years, has been gaining share from weaker and weaker players in their respective markets. So yeah, so basically, though there is no direct competition, and within Little Champs, we sort of have invested in the dominant players.
So let me also give one more data point, right? If you are investing in large cap companies which are going to turn around, right, from being the 5th largest in their sector, right, to becoming the 4th or the 3rd largest, then this question is a valid question. Those large cap companies might actually still not deliver return for you if consolidation is the way forward. But at the same time, if you're investing in a dominant small cap franchise, because the industry size itself is small at this point, right, then the same logic which applies to an HDFC Bank in terms of consolidation or Asian Paints will also apply to the 14 stocks, 15 stocks that Ashwin has in his portfolio. So okay, so Salil says that that's pretty much answering most of the questions. I'm sure there will be some which we haven't been able to answer. It's also 1.5 hours into the webinar. So we will end it here. But whoever has asked a question which we haven't yet answered, we will send a one-on-one reply to you over the next few days. Thank you so much for attending it. All the best.